Hello guys, glad to have you on board again today. You know what time it is, so let's jump right in. The thing is that we're still in the same old context. I've been putting a 4-hour chart in here so we get the broader picture of it. Though we still have the same old story, big, nice weekly area in here that has been positively reacting on the longer time frames. Though the bullish flows have been setting themselves, 1, 2, and we're currently pending for the third one. And still have to account for the fact that there is a very shaded gray areas in here, in the matter that there is a significant difference to the fact that we've already dealt with those prices in here, but solely on the futures market. So if you have a look at the SPX in here, which would be the cash equivalent, you would see that this area never been traded before during the regular trading hours. So in that perspective, well, we would say that it depends on through which lenses you're actually looking at the market. If you're looking at it in a true cash market perspective, well, these prices never have been traded in here. So that's the first time we do, and in that perspective, the same flow strategy would be triggered already, meaning that basically in here, we would still be bullish in this market, and we'd rather like to be bullish quite soon rather than later, because in that perspective, well, we have to go bullish, otherwise we're going to reverse this context, which will cause a third range boundary. And remember that the third range boundary triggers the end of the trading flow, okay? So for now, the cash is still headed upward, and it has to keep on going upward. The next target will be 42, 45 or something like that. We also have a cash gapping area to close out there, so that would make kind of sense. Though we need to understand that the momentum is crucial in flow trading, and in that perspective, well, despite the CPI numbers and all alike, we would like to see this market keep on performing, otherwise it would sign the possible end of this thing. Of course, that also means that as we've gone context to context, we have rebounced, though if we ever get back down to that support, that's going to be, in my personal trading, the sign to take my profits for the whole flow trading that I have. I've got multiple trades in here, like some of them here, I've got those, so I've got so many trades in here, and I will profit take them if we ever go back to the support, just because if it breaks down on the cash, that will be the sign that the flow is terminated. But on the other hand, there is that complicated stuff, which means normally I do pay attention to the futures market more than the cash market. And in here, the story is significantly different due to the fact that, well, in order to trigger that third flow, we need to break above the previous high point, which we've failed to do so far. We're still trading below it. There has been this couple of candles, but that's not necessarily enough. So in that futures perspective, well, the market never started the flow for now, which means those third range boundaries that we have in here, I don't pay too much attention. Oh, sorry, it will be there. I don't pay too much attention to this because, well, the flow isn't started yet, though the third range boundaries always matter when the flow has started. So if you figure that one out, it might be tricky for you to figure out which one is the right one, and that's exactly the reason why I can't give you an answer. And when you dive into this shaded gray territory, in which basically you've got two possibilities, both following the strategy's rules, and it mostly depends on which one you're going to choose. Well, pick one and decide. My personal assumption in here is, well, I won't decide in this shaded gray area. I will just remain open for both probabilities. So what that tells me is that, well, as long as we're in this area, I will not pay too much attention. Of course, if we break these low points, I'm definitely out. But until then, the thing is, well, I know it's going to be volatile in here, and I accept that uncertainty. What that tells me is that basically every trading activity that I do in here, and I still buy each and every H1 timeframe bottom, just like I did last week, that means I have a different approach. As long as we're in this area, I am profit taking quickly. But basically there was an H1 low point in here, I bought and profit took. I did it the other way around, buying in here and profit taking very quickly before the CPI. Though I always support this market, but I take the profits quickly, okay? So that's really the way it is. And I'm waiting until one of those two things tend to send the signal. So if the SPX cash reverses the context, that will be the sign to me that some red flags are starting to show up. On the other hand, anything noisy that may happen in the futures market is none of my concern. I'd rather like to still be bullish, but I am not adding to the existing positions. I am just going in and out to take some quick-term gains, okay? So that's really the way it is. Other important stuff has happened yesterday. Some people have noticed that the VIX has reacted in much bigger proportions compared to the indices, and that's the same old story. Lots of people don't understand what the VIX truly is. It's nothing more than out of a 30-day expiration date, we take all the puts and calls and we measure the spread between them. So basically what that tells you is how much speculators, okay, those guys don't pay attention to where the market is going in the long run. It's just 30 days kind of bets. So this is the gambling stuff on the market, though basically the VIX measure how wide these gamblers' expectations are on the 30-day periods forward. So what that tells us is that over the next 30 days, both buyers and sellers of derivative options are basically saying that, well, we don't think the market's going to be that far away from the current prices, or at least less further down the line than we were just a few days before. All right, sorry about that one. So what that tells us is that, well, it isn't neither a bullish or a bearish sign, though the only thing that I would do here is to say, in my overall longer-term forecasts, we've reversed in here the channel, which is the sign to me that we're headed into that final structure in here where I think we're going to build lower lows in the volatility. So the market's tension, overall tension, is probably going to reduce. But the thing is that, of course, this kind of channel is broad and it's going to be tested up and down multiple times like you've seen before. I mean, trading volatility is no such a thing as a calm river. It's really, really going to be peaks and troughs repeatedly. So in that perspective, well, I think we're mostly in a trough area rather than a peak. So I would say there are significant chances the volatility rebounds within the next few days. So still trading in that riskier or at least complex area which we're in, and we're still trading in that area where we would rather like to be cautious, patient, and don't try to be too violent in terms of market expectations, in terms of returns. Easy in, easy out, and don't try to pile up existing positions on those areas. No pyramidic stuff like that. Just try to go easy in, easy out. That's what I do, and that's definitely what the VIX is telling me to keep doing as long as we don't have a definitive direction. And don't say that you know where it's going, either bullish or bearish. There are really the two possible outcomes in here and need to be ready for both. In my case, both of them will be gains. If we go up, I'm going to pile up some nice gains. If we go down, I'm going to exit positions with gains. So that's really the nicest position to be into. The 10-year yield has given us some interesting signals yesterday with the CPI. As you've seen, the S&P 500 just plotted some random candles with lots of up and lower shadow candles. It's not the case for the 10-year yield, who's been breaking resistances and closed above. So that's still the sign that we're trying to break that median average. Of course, this is from a rising moving average, so you know the drill. There is always a third range boundary, which has been there. So the market now might be eventually going for this and trying to break that third range boundary, which would be the sign that this range is over and that we're going to break above it. So until then, that is still my favorite trade at the moment. This is where I personally think that there is less risks to be bullish in the bond market, or actually bearish in the bond market, but bullish in yields. Though in that perspective, this is where I am. The thing is that I've always mentioned, whoever is trying to do this must account for something that you probably don't necessarily know all about, and I cannot explain it in greater details, but the liquidity in the bond market is critically low, though you rather like not to be fully exposed. So I have reduced position sizing compared to what I would normally do in such markets. So despite the high conviction, I can't go full force in this market, but I am still bullish in yields, though bearish on T-bills. That's really the way it is, okay? Euro dollar hasn't been moving too much, though like we stated, this trend line in here is the 30-month, the 3-month, the tremendous quarterly time frame kind of speculative area. And like we stated, I think this area, we're going to spend multiple other quarters trading against that price. So I don't necessarily think that the forex market is going to be of any interest in 2023. Nothing but very, very tricky and trappy. So please, guys, stay the hell away from this. Last but not least, the silvers and gold, very interesting to me. They're triggering a hell of a lot of bullish signals, which so far tend not to validate. I'm waiting for them to turn around, to turn against and back up to the trend channel. For now, they fail to do it and keep on just pushing down and triggering signals. We now have clear exit signals in here, so I would say this is probably one of the last times that we're going down. This area is where I will willing to buy long term. So for now, I am accumulating silver with tiny positions, speculative positions. In here, I would have much larger portfolio expositions, of course. So I'm really just scratching the surface, waiting for this guy to tell me what the answer is. But of course, I intend, now that we have exit position in the H4 time frame, to see these markets reversing brutally back to the trend channel. Until then, well, this is just going in slowly but steadily with consistently tiny position piling up. Anytime there is a signal, I'm buying a bit. So for now, I'm just cautiously waiting for this. If it enters the long-term area, of course, I will stop the short-term trading activity and focus more on some more speculative longer-term expositions of the portfolio. That's pretty much all about it for traditional finance. Then when it comes to cryptocurrency, yeah, we might be starting with Bitcoin. So same thing in here, we had that big range. I was still expecting for us to go up and keep on pushing in that kind of flat consolidation, bullish outcome, but we failed on this. We've created a very, very weird, but still I think valid kind of third range boundary in here. So the market has fallen, and therefore that signs the end of that bullish flow. Remember, that was first flow, second flow, very long and extended flow. So remember what we stated: when the market goes further than expected in the right direction of your trades, instead of fearing the fuck out of it and saying, well, I need to take those nice gains as quickly as possible, you rather like to step down, zoom out, and try to figure out why the market is so excessive. Though in that perspective, we stated the market is excessive because, boy, we have nothing to do in these areas. The demand areas for bears are much higher, and we're gonna find our way up there. It's just a matter of time. So until then, we still have now confirmation that this flow is terminated because it's built a third range boundary. Okay, so we've got a range in here. It's already mature. We've got 4 range boundaries. It's very, very bearish, but as you can see, it's barely retraced 23 up to 38%. So gosh, Jesus, don't be bear on such cases, okay? So all I would like to say is that now we have a mature range. It's already retraced barely 23, could go 38, but anyway, this is not a mature trend, or this is not a primary trend. So you can't say, well, Phil, this is a pullback. No, there's no such a thing as a pullback when you're trading in flow. Flow trading don't nearly give a fuck about Fibonacci retracement. Flow trading cares about volatility. So the only thing you should pay attention to is the volatility boundary on the H1 time frame. So look at this volatility boundary. Where is it? It's doing this, okay? So here's the volatility boundary. So we're already in the areas in which you can buy for the third and final flow. So in that perspective, we just terminated the second flow, and we're already in areas in which we could stop the third one. So God damn it, don't be too bearish. I think the next area to trade is to go right back up here, retest the third range boundary, and 2 things can happen there. Either we do it in conjunction with the bearish third range boundary, the bearish volatility boundary, and that would be, in my humble opinion, the sign to extend that range in a longer period of time if it doesn't break. Or option number 2, we get out there and nothing happens and we go for the third flow. So just try to be rational enough. I'm not nearly bearish on crypto, don't nearly think they're bearish, but the thing is that it's not an appropriate time to load up more speculative trades. I still have exposition for this flow in because I couldn't sell on that third range boundary. Though the thing is that I would be stupid to load up some additional trades for a third trade, for a third flow, while I still have the second flow in. So my current stance is I'm going to wait until we retest those third range boundary, and I'm pretty damn think we will, and I will assess on these areas, depending on the signals, whether or not I will profit take my second flow. If I do this, well, that means I will have risk available to eventually buy another retest of the lower Bollinger Bands. But remember that I've seen some people saying some stupid shit like, well, look at this structure fill, head and shoulder, or whatever it is. Well, try to be smarter than that, folks, okay? When you trade on the lower time frames, below where the lower strategies are, there's no such a thing as patterns or stuff like that. There's just one thing, volatility and market makers arbitraging the market, and there's nothing you can do about it. So don't make it overcomplicated. Make it simple. Look at the damn volatility boundaries and trade there. And if you end up taking a stop loss, just take it and move on to the next trade. But the more you try to overthink things in these lower time frames, the worse it will be for you over the long term. Okay, so that's the same old strategy, I guess, for Ethereum. We've got a delayed third range boundary right there, which terminates the flow trade, okay? And same thing in here, we're already in the lower volatility boundary. So this is not an area in which, oh, I should capitulate and take my stop loss. No, same old story. We're going to go back up to the third range boundary, and we'll see what happens there. If the market takes some profits, which could be a possibility, I definitely think that's the likeliest outcome, I would do just that. I would take the profits on these nice trades that I've been looking up all over the place, and in that perspective, I'm going to be taking a nice gain, stepping back for a second, and let the market decide. Of course, as there is still a third flow to trigger sooner or later, I will always be buying the lower volatility boundaries. But if you got my point, as I am still in the second flow, I can't do it now. I can't add up to the existing position. I need to exit them first. So if we go there and if I take my profits, then and only then I'll be willing to buy the lower Bollinger Bands. Do you understand that? I hope you do, because I try to make it as simple as it is. But flow trading is really all about that. I know where the speculative areas are, and I will manage my risk depending on how the market behaves. Okay, we have delayed third range boundaries in here, which leads me to believe that we're going to go right back up there, and this is where the market will make its final decision. Do we extend the range, and do we need to consolidate one more time to load up some fresher bulls in the market or not? We can definitely break out of these, okay? We can definitely go out back here and trigger the final flow. So that's also the reason why I am still bullish, but I'm also cautiously optimistic on both ends, both the S&P 500 and the crypto market. To me, it all sounds like this is the same old story out there. It's just take different forms on all of those markets. They all point to more bullishness to come, but we, for whatever reason, failed to find the appropriate short-term catalyst. But we'll see all about that. And of course, there is still a significant chance that, well, these things simply don't play out. And at some point, profit takings outpaces the demand. And in that perspective, well, the market could take the profits and go lower. But I still think that this market can hardly reverse the way it is. I think if we want to be bearish, we first need to build a solid resistance, which so far we haven't. We'll see all about that. Some people will argue that this is an absolutely visible distribution, a Wyckoff pattern or stuff like that. I would definitely agree eventually with that. But until then, well, I'd rather like to have my stops being triggered at break-even and losing all of my gains one by one, rather than taking action based on stuff that my strategy doesn't account for. So I'd rather like to be proven wrong, still having followed my strategy's rules, rather than listening to external bullshit. Or I call it bullshit. That doesn't mean, I mean, some people may trade it that way, but I don't. So consistency in applying my strategy has always been my safest play, and I will always do this. So trading Wyckoffs or whatever is not part of my strategy. It's just that if it had to be that way, well, it will be that way. And if all of my gains have to be unwinded, I will accept it that way. That's no biggies, okay? But I can't say, well, there is Wyckoff or whatever that is, and in that perspective, I'm taking all my gains and go fuck out. I don't see it that way. So that's going to be it. I don't know. We're in very tricky areas. I accept both outcomes. I'm ready for both of them, but I still think that I'd rather like to let you understand that. Why am I still cautiously optimistic rather than cautiously bearish? Just because the low risk strategies, the one that we pay attention to each and every Monday, just points to upside potential. So that's the only reason why I should be 50-50, but I'm not, because my longer term time frames where the risk is lower is telling me more upside than downside. So I'd rather like to be cautiously bullish rather than cautiously bearish. But I would understand the bears in this current area, and they definitely have a word to say. You just have to pick a side, or pick no side, and be ready for both outcomes. That's what I do personally. For the short-term exposition of the portfolio, I will be ready for both bullish and bearish outcomes. For the longer end of my portfolio, I definitely stand for what I said Monday, that I see no signs of bearishness for now. That being said, bye guys.